relatively briefly. Firstly, a bit of introduction to Resonance itself and what we do and how we approach impact investing. Secondly, investing in housing with an impact lens. What does that mean? Some themes that come out of that. And then a bit of detail about how actual funds are working in this area to deliver that type of impact through property, and a few conclusions, I hope. So if we could go to the next slide and the one after that. So just to briefly introduce Resonance, we are an impact property fund manager. We've been working on impact investing in the UK now for 20 years, and we have a team of 50 across the UK in 5 locations. In terms of our property impact themes, they are homelessness, learning disability and vulnerable women, and I will go into a bit more depth on each of those as we go through the presentation. But if you just flick to the next slide, please, to give you a sense of current scale of our activity there. We've been running those property funds now for 9 years. We have about £300 million worth of funds under management, which is largely deployed into residential property for those needs across 7 operational funds. And that totals around 1,000 homes at the moment and over 2,500 individuals and children in those properties. And Resonance itself over the years has been acknowledged in a number of ways, particularly in terms of the property sector and what we do, impact investment sector, and also our work with local authorities and recently with local government pension schemes. So just to contextualize our approach to impact investing in the broader ESG arena, I hope the spectrum of capital that I've shown here may be familiar to some, but it may not be to others. We think it's quite a helpful way of just teasing apart the different definitions that people are using in the market at the moment. And it starts on the left-hand side clearly with the traditional investment approach, which may take no acknowledgement of the environmental and social impact of that investment, which is clearly a bad thing. Right to the right-hand side of the scale where you have philanthropy, which is all focused on environmental or social outcomes, but may not have any financial return attached to it. And clearly there's a spectrum between those two things. And I think the distinction that we can draw is the responsible investment approach, which is moving across that spectrum, is really seeking to avoid harm and mitigate those environmental, social and governance risks, which is a good thing. Moving further to right, sustainable investment is now seeking to more actively target the benefit of stakeholders, be they people or planet. And then you get to impact investing, where I think the distinction is the intentional contribution to a solution, be that an environmental problem or a social problem, through that investment. And that impact space does have a portion on it which can deliver competitive risk-adjusted financial return, and that's the bit that Resonance focuses on through these property funds. There is impact investing to the right of that spectrum, which is seeking to achieve impact and can tolerate higher risk and trade-off returns. But with our property funds, we're not seeking to be in that space. And I think the reason that we are in the space we're in is just the inherent nature of the investment does generate a good risk-adjusted return for investors, and the scale of the investment is one which is now increasingly relevant for institutional investors, as we'll come on to describe. So in the next slide, I've really just panned back and said, well, if you invest in housing with an impact lens, what can that look like? And for us, the starting point is, well, what is the need? What is the social need that is seeking to serve? And I've shown 9 areas there which could be served through housing. It's important to say we don't try to cover everything. We focus on the 3 that are listed across the top there. The reason for that is that we have always taken the approach of starting with the need and with the social enterprises, be they homelessness charities or learning disability housing providers, whichever organisations we think are serving that need most effectively. We start there and we look at their property need and build back from that to an impact fund that can serve and scale up a response to that need. So that means we don't try to cover everything that we could across all property needs. I've shown also along the bottom of that slide some of the Sustainable Development Goals, or SDGs, which I think, again, many will be familiar with. And again, this type of impact investing can tick a lot of those boxes, and we do map the impact that these funds have against those SDGs. But actually our approach to impact measurement and management is much more based on the individual needs that the funds are serving. So again, I'll come on to describe how that looks for specific funds that we run. So then to zoom in on how we have implemented property funds around those three core themes. In homelessness, we have the National Homelessness Property Fund 2, which is addressing what we believe is a £20 billion homelessness property need in the UK, which I will describe the basis for that in a minute. We have, within the theme of vulnerable women, recently launched the Women in Safe Homes Fund as a partnership with another fund manager, Patron Capital. And that is, we believe, the first gender lens impact investment property fund. And I'll come on to explain why we think it's important to focus in that particular area. And thirdly, in the learning disability strategy, we have the Resonance Supported Homes Fund. And that is looking primarily to pioneer a better long-term leasing model for the learning disability sector in partnership with the charities and housing providers we work with. So before I go into the specifics of each of those areas, I thought it would be helpful just to give a generic description of how a property fund like this works, just so everyone's clear on the way that money goes in and money comes out. So on the left-hand side, we have investors who are investing into these property funds. Then those property funds are acquiring and refurbishing property, in some cases developing it, but primarily acquiring and refurbishing property, and then leasing it to charity partners, housing associations, and the like. And I'll describe some of the specific examples of that in a minute. And those charity partners then are managing the tenancies for the tenants that they're serving. And they are also receiving rent on those properties. In many cases for our funds, particularly homelessness, that rent is based on local housing allowance. But in some cases where there are some higher support needs, it is also based on exempt rents, which is another form of housing benefit, particularly appropriate where someone has a higher support need. And obviously what that means is that the charity partners, in receipt of that rent, can use that to pay the lease. And it's an important principle for us that the basis of the lease should match the type of rental stream which the organisation is receiving. That we don't believe that's always the case in the market for leases that are offered. And it's also really important to us the choice of that charity partner, and our due diligence on charity partners is all about whether they do have a focus on the tenants and they have an expertise in managing that specific tenant's needs, and in many cases helping them progress where that's possible to greater independence. So that's the kind of generic description of a property fund. But what I wanted to do for the last part of the presentation is just to go deeper into those three areas I mentioned and really show why we think that they do need addressing differently through the specific initiatives that we've launched. So the first is homelessness. And on the next slide, I've given some of the stats which exist on homelessness just in England, although we do focus across the UK. 2,688 people estimated to be sleeping rough on a single night in autumn 2020 in England. Now, that is the tip of the homelessness iceberg across the country, because behind that, there are 100,000 households in England who are effectively stuck in temporary accommodation of one form or another, be that hostels, bed and breakfast, travelodge, housed really often at the expense of a local authority, but also at the expense of their own ability to get on with their lives and move on. And that's often a problem about people getting back into private rented accommodation when they have had a vulnerable or homeless background. And behind that, there are 1.16 million people, households on the social housing waiting list. So this is a huge need. And if we look just at the temporary accommodation figure of 100,000, that's a £20 billion property investment need to create the properties and pathways for people to move on from those circumstances and be able to access the private rented sector. So that's a huge need, and impact investment can be part of the solution to that. So the next slide just shows the way that the National Homelessness Property Fund 2 has been seeking to address that. This is the most recent fund that Resonance has launched in a series of homelessness property funds over the last 9 years. This particular fund is seeking to raise in excess of £100 million. It's already raised the first 21 million of that from its initial investors. It's a 10-year fund, and it's investing directly into residential property with 10-year leases. And seeking to acquire, at least in its initial raises, around 870 properties. Now, these are all properties that can be used for the move-on accommodation to alleviate the temporary accommodation problem across the country. And when we look at the impact of these funds, we look specifically at how that's working for those tenants. So 3 areas. Firstly, are the tenants sustaining the tenancy, and in doing so, are they gaining more opportunities to move on eventually to other private rented property? Secondly, are they making progress towards employment, or if employment isn't possible at the moment, education and training? And thirdly, are they becoming more resilient to homelessness as a result of re-establishing social connections, increasing their financial management, etc.? So we look at quite granular data about whether this is working in specific cities and in specific charity partners that we work with. Some of those charity partners are shown on the right-hand side of the slide. This fund has started with an initial focus in the Northwest, working with a consortium of housing associations who have come together around the homelessness issue in particularly Greater Manchester. And that's a consortium called Let Us. But we're also working through this fund, beginning to work in other cities in the southeast and the southwest, and indeed in London. So that's homelessness. I'll move on then to the second theme, which is vulnerable women. Now, if we look at the background statistics here, we see 1.6 million women in the UK experienced domestic abuse in 2020. So that's a huge number, but behind that, there are some even more shocking statistics, we think. And that is that half of the women who were referred to a refuge, more than half of the women who were referred to a refuge, were actually turned away due to lack of space. And then if we look at women coming out of prison, more than half of those women do not have a home or a job to go to on release. And if we look at the more recent effects on those problems that the pandemic has caused, again, over 60% of women who are living with an abuser said that domestic abuse had worsened during the pandemic. So there is clearly a huge need here. And that need is being primarily met by a brilliant network of women's sector organisations across the UK, often women-led, which are able to provide the pathways that women need in those extreme circumstances. So that's a huge need that needs focus from a property investment perspective. And it's organisations that were telling us that that's what they needed that prompted the focus for this fund. So the Women in Safe Homes Fund, as I mentioned, was launched in the last 12 months after a lot of research and work with women's sector organisations across the country to design the way that it would operate. And we've done this fund as a joint venture with a really top-class investment manager, Patron Capital, who have focused on property investment in a more mainstream way for a number of years. And with our impact property focus, we've teamed up to deliver this fund together. This is a fund, again, which has an ambition to raise more than 100 million in its eventual capital raise. It's already got over a quarter of the way there in terms of its early raises from a range of investors. And again, it's a 10-year initial focus for the fund and for the leases. And again, this is a fund that could, even with that, deliver between 650 and over 1,000 properties. And because sometimes we're not talking about necessarily long stays for women, in some cases these can be short-term interventions for women before they then move on beyond that. It could, over its life, positively affect the lives of 6,000 women. And when we look at impact for this fund, we're obviously looking at a range of different circumstances women are in. So the primary question we're asking for impact is whether the property is meeting the needs of that particular woman. And so that might, in the case of domestic abuse, be the security or safety features of that property for that woman to feel safe in the environment that she moves into. But we're also importantly measuring the strengthening of the women's sector organisations themselves, because in many cases this fund is able to partner with women's sector organisations who may not have as much experience of housing management as other larger organisations, and it's an intentional impact of the fund to give them the opportunity to build up that experience and that capability and the properties to deliver those tenancies. So we've shown on the right hand side of this slide a range of the organisations that we're working with initially. Some of them relatively well known, like Refuge, others less well known but should be better known, like the Preston Road Women's Centre in Hull, which also goes under the name of Winner, and a number of others who are initial partners of this fund. And then finally, just to focus in on learning disability. Again, the headline statistic here is 1.5 million people in the UK who have a learning disability. But behind that, again, the real motivation for this type of impact investment are the statistics that are less well known and less seen. And that is that over 80% of local authorities have said that they have a shortage of suitable housing for adults with a learning disability. And that means that there are a large number of people with learning disability who will be living in either a nursing home or even worse, in an inpatient hospital, which at the end of the day is not somewhere where people want to be, and is often a long way from family and support networks. So really the motivation of this fund has been those organisations across the UK, excellent learning disability support providers and housing providers, who have said, we can do this better. We can support people to live in the community with support, often much closer to family and support networks. But we often lack the right property on the right terms to do that. So the response to that has been, on the next slide, the Resonance Supported Homes Fund, which we co-designed with charities and housing associations with a focus on learning disability. That fund, again, has launched relatively recently and is targeting, again, around 100 million of eventual investment, and it's reached the first 15 of that in its first 2 closes. That's a fund that in principle is evergreen, which means it will continue to operate for as long as it needs to. Every year, 8 years, does give its investors the opportunity with some conditions to withdraw their investment if that's what they need to do and be replaced by others. But it's looking for to make investments into property and then lease them on 20-year leases, which is really reflecting the fact that for many people moving into a property in these circumstances, it should be a home for the foreseeable future, if not life. And we've shown there the number of properties and people housed as a result of that type of investment. And again, when we look at impact for this type of fund, we obviously have very bespoke needs that in each individual circumstance are being met. So we're looking to measure whether the tenants' expectations have been met for their particular needs, and also which factors of the accommodation have made a difference to them personally. And we can feed that back to our partners and improve this model over time. So those are the 3 themes. I think, again, just to pan out again to some of the things that are common across all of them from an impact investment perspective. The blue hexagons on the left show some of the factors which we believe reduce risk in this type of impact investment. And I think it's often a myth that impact investing is necessarily high risk. In fact, impact investing can be low risk in many ways, because it seeks to do things, particularly in the case of tenancies, which are focused ultimately on good housing providers who have their tenants' interests firmly at heart and embedded in their mission. That's a low risk way of providing housing to people. And then on the right hand side, sorry for the previous slide, it really then just highlights what results from that type of investment strategy. Just to pick out a few things, we end up with highly diversified portfolios of residential property, not concentrated into big developments, but scattered across the major UK cities in a very diversified way. We end up with solid, predictable yields from those investments, which have a good long-term inflation correlation, but are not strictly linked to inflation each year, which is one of the problems which has arisen from some other lease forms in the market. And ultimately, they have a high social impact, which is obviously the motivation. So just to conclude, two final slides, hopefully leaving enough time at the end for the questions. Some examples, not our entire investor base, but some examples of some of the investors who've invested in this type of fund. Across those logos, I guess just to pick out a few types of investors we have had, particularly in the early days of some of the more pioneering funds, often had endowed foundations investing from their endowments. So a good example of that is Esme Fairbairn Foundation in the bottom row. That's a foundation with over £1 billion in its endowment, which it invests for financial return to maintain and grow that endowment for the work that they do. But when they can invest in funds like this, which also deliver social impact, they're obviously very keen to do that. Second group of investors that you see here are local authorities who've invested into a number of these funds because of the desire to see the impact in their particular region, but again also investing with the return requirement given that they manage public funds. So examples of that are Greater London Authority, who've invested into some of our London homelessness funds on the top row. Bottom left, Bristol City Council, who've invested again into that theme. And then more recently, we're beginning to see a lot of interest from the institutional investor market as this type of impact investment scales up. And a good example of that is Greater Manchester Pension Fund on the top row, who've recently invested into the National Homelessness Property Fund 2. And there we see pension fund investors who obviously need to show that they're delivering good risk-adjusted returns for their pensioners, but also want to have a good diversification in their portfolio. And this type of residential property can fit well into a pension fund portfolio, and it's a long-term investment with some attractive features for those types of investors. So I will conclude on the final slide with just drawing out a few themes, hopefully conclusions that are helpful for people. The first is, we believe ESG is now just a minimum benchmark for any form of investment. And impact investing is an interesting extension to that, which is looking to actively contribute to solutions where that's possible through investment. The return profiles for that type of impact investment can be competitive and can have attractive long-term diversifying features for investors. And the scale and track record of this type of impact investing is increasingly there. And that means that because the investment needs are large, institutional investment is now really becoming a reality in this area. And a good example of that I would mention for people to look at, if you haven't seen it already, is an organisation called Pensions for Purpose, which has been founded to allow pension funds to really get involved in impact investing in a way that's appropriate for them. And then the final 3 points here, social and affordable housing is really an area where there can be attractive long-term investment characteristics for impact investors. Again, I would point people to the Impact Investing Institute, which has a great website on which there is a recent report about social and affordable housing and how that can work in impact investing. I would commend that to you. Impact focus, we believe, is not just delivering high impact, but it's also about managing and reducing risks, which are inherent in all types of investment. But often impact investing can help reduce risk in investment. And finally, we believe that this type of impact investing, particularly through these types of property funds, can allow investors to see some local impact in the region where they may have an interest, but actually also be part of a bigger fund which has a national diversification to it from an economic diversification perspective. So that's really all I was going to say. Hopefully I've left enough time for the questions. Looking forward to those.
Brilliant. Thank you very much, Simon. Some really interesting and very important topics there. Yeah, we've got some questions coming in. So firstly, can you just clarify, you mentioned in the conclusions there that institutional investment is a big thing, but can you talk about how retail investors can access the fund? It appears, like, please confirm if this is the case or not, that they can only access community share issues.
So that's an excellent point, and probably one I should have made right at the front of this presentation. These particular property funds I've been talking about today are not appropriate for retail investors, and obviously we're not promoting these funds on this particular discussion to retail investors. So I think the challenge for retail investors is obviously that the regulation means that there are only limited forms of investments that are available to retail investors. We have, though, recently seen some forms of listed funds which have come onto the stock market, particularly the Big Society Capital Schroders Impact Trust, which is, I think, IPO'd just before Christmas last year, which is giving a kind of diversified exposure to different forms of impact investment and other funds through that listed vehicle. So that would be, I think, quite a good example. Again, I'm not promoting that particular fund, but you asked for an example. And then, as you rightly say, actually, for retail investors, community share offers are a really interesting opportunity for people to get involved in impact investments that are often, local and very tangible. And I would point people to the ETHEX platform, ETHEX, as a really great way of getting an exposure to what some of those investments can look like.
And do you have any plans to improve access for retail investors?
We would always love to make impact investing as widely available as possible, and certainly Resonance does have a long-term goal to make that possible, and we are actually involved through some of our other funds and directly in community share offers, not through these property funds that I've been talking about today. So on our website there are some more examples of the way people can get involved in those types of investments. And yeah, I think over time we would like to see even this type of property investment become more and more available to retail, but again through appropriate structures.
Sure. Do you have any plans to raise additional capital and to grow AUM?
Yes, according to the needs that we see here for this type of investment. And I think I've described the scale of the need in homelessness, which is now evident. And so particularly in that area, we are already scaling that up in discussion, particularly with the local government pension schemes, for whom this is a very natural area. But actually in those other two areas, the Women in Safe Homes Fund has interestingly attracted investment from outside of the UK. Although the fund itself is solely focused on women in the UK, I think its gender lens has meant that it does draw a wider interest from international impact investors as well.
And how is the portfolio broken down between those themes that you mentioned?
Excuse me. At the moment, we have invested most into the homelessness theme because that's been running for the longest, and therefore naturally that's the one where we've deployed the most investment. But the two more recent themes around vulnerable women and learning disability are also growing fast. And as I stated on the relevant fund slides, each of those has an ambition to raise in excess of 100 million. So there's substantial investment that's going to be made into all three over the coming years.
Do you have a minimum investment size for the funds, and what drives this?
We do. If we look at the homelessness property funds, that minimum investment size, so the National Homelessness Property Fund 2, is one that's really only appropriate now for institutional investors. So, you know, we usually take commitments into that fund of 5 million or more. For the Women in Safe Homes Fund and for the Learning Disability Resident Supported Homes Fund, we will take lower commitments from investors at the early stages of those funds as they build up their track record. We find some family offices interested in investing into those funds. We even find some sophisticated high net worth investors who have to pass various regulatory tests, but can nonetheless invest into those funds as well.
Thank you. So some of the funds are fully invested and appear to have a fixed life. What sort of returns are you generating over those periods?
That's the point at which I have to say that I think if we go into specific returns on funds, we may be entering into the area of financial promotion. So I can't talk about actual numbers on returns. But what I can say is this type of property investment, the return is obviously generated in two ways. One is through the rental yield, and the other is through the eventual appreciation of the value of the property over the life of the fund, which can eventually be sold, even if it's sold at an arm's length market valuation, into a follow-on fund that still uses it for that same purpose. So if we look at the total return that comes from those two aspects, then this type of property investment is very comparable and can be benchmarked against traditional residential property funds of a similar nature.
And what happens when you get to the end of a fixed life fund? Do you roll them over, or do you start a new fund?
So our approach to that really is that the exit for these funds, ideally, as I mentioned, would be to a continuation fund that could continue to use the portfolio for a similar impact use. The condition to that, though, obviously needs to be that transfer of that portfolio would always be at an arm's length market valuation, so that investors who are exiting would know that they could get a good market price at that exit. Obviously, that's in some cases 10 years or more hence, and there could be circumstances in which it might be more appropriate to sell the portfolio to other social housing providers if it was no longer needed for the purpose that it was originally created for. But there are many ways to achieve, you know, exits from these property funds which preserve impact, as well as giving investors the exit that they sometimes need at that point.
Obviously today is Social Day, but to what extent do you think about environmental and governance issues? For example, do you have plans to add rooftop solar to parts of the property portfolio?
So both of those are absolutely integral to us. Although we are focused on social impact, as I mentioned, we sit within that broader spectrum of the ESG market. So if we look at environmental concerns, we absolutely have a strong focus on the environmental performance of the properties that we have within these portfolios. We have criteria for the EPC, Energy Performance Certificate, of a property that we would acquire, and also targets for getting those energy performance certificates to higher grades over the life of the fund. Interestingly, that's always been integral even to the social mission of the fund, because obviously, you know, higher energy efficiency means lower bills for tenants, and that is a good thing from a tenant perspective, even aside from the ecological benefits that brings. But we are absolutely focused on the quality of the environmental performance of the portfolio. And then from a governance perspective, again, I just refer back to the comments about our choice of housing partners always being completely integral to us, that we due diligence our partners very strongly for their governance and for the way that they are running their organizations, so that we can be confident that over time, you know, they'll be able to adapt to tenant need, and in some cases have to adapt the way they operate as regulations change, and as new issues hit the economy and society. But if we have partnered with well-governed, strong organisations that have a mission at their heart, then we know that we will not go far wrong.
Thank you. What are the risks that come with investing in these sort of social impact projects, maybe those that traditional equity investors might not be aware of?
Well, I think I would go back to my comment and my final point, you know, from the presentation, is that often in some ways the risks can be lower than in some traditional areas. So, you know, we have more diversified residential portfolios than some other residential property funds who tend to invest in bigger blocks and developments. So I think there is a first point that needs to be made, is it's not always riskier on the impact side. I think some of the risks that people refer to often relate to policy environments, and whether or not there could be changes of policy environments for some of the particular social areas that we're focused on, be that homelessness or learning disability, or provision for women fleeing domestic abuse. I think, yes, that's true. Government policy can affect over time some of these areas, but I think we would also argue government policy affects all areas of the economy, and all investors ultimately have to be confident they're investing into a good model for, be that a business or in this case a social enterprise, which, if it's a good model, will tend to ride through, you know, some of the year by year or even decade by decade changes to the way that government pursues different aspects of policy. So yeah, yes, you need to keep an eye on the way that government is setting policy, but we don't think it's a very different risk to the one investors normally take.
Thank you. To what extent is income government backed, and how does this vary across the different themes?
Yep, great question. So fundamentally it's income backed because most of the tenants in these properties across these themes are in receipt of some form of government benefit for their housing. I think the distinction is between local housing allowance as the basis for that, which is where there is lower support need. And that is the bulk of what we do with the homelessness property funds, is lower support need and therefore LHA based. And then in some cases where there's higher support need, and that's more with the Women in Safe Homes Fund and the Resident Supported Homes Fund, then there is an exempt rent which is available to tenants with higher support needs. But again, that is a government-backed rent. So those are the kind of two basic forms of government-backed rent that are applicable.
Some of the funds seem to target quite specific regions or cities within the UK. Is there a particular reason for picking those areas?
So sometimes it's to do with the concentration of need. And certainly our homelessness property funds did start in London, because that's where about 60% of the UK's temporary accommodation need is focused. But actually, you can see from that 40% of it's spread around the rest of the country. So there's equally a need for outside of London. And when we go to regions, it's often motivated by our housing partners, who may be regionally based and have a focus in that region and a deep understanding of how to provide that service for people in that region. And sometimes it's also linked in close collaboration with some of the local authorities, and even more recently some of the local government pension schemes. And there again, I think, you know, with a strategy like the one we have, we can look at a region and see that the rentals and the property prices will allow us to deploy in that region and to achieve the fund's goals. So there's not a risk of you know, not being able to achieve a deployment in a particular region if we've done our research.
Sure. Are there any specific areas that you're looking at for potential funds in the future?
Well, all three of those initiatives are national, albeit that, you know, they've started in some different regions according to, as I mentioned, to the housing partners and the local authorities that we've initially partnered with. But all three of them have the potential to affect all regions in the UK. And so that's where a lot of our discussions are at the moment with different local authorities, different housing partners, to see how far we can you know, spread the reach of these funds.
Sure. And what kind of events or situations might cause you to sell out of an investment?
Very few, because these are fundamentally funds which buy normal homes on normal streets with a lot of due diligence and some good refurbishment, and then we look to hold them you know, for this initial 10-year period, and then ultimately can on-sell them into continuation funds to hold them for longer periods. So this is not a kind of trading in and trading out type of investment. It's very much a buy and hold and use for impact, with the investment characteristics that go along with that.
Thank you. As I've asked all our managers today, what were your key takeaways from COP26?
Yes, interesting. I was at a local government pension scheme conference yesterday where, you know, people were reflecting on the same question. And I think, you know, there's been a little bit of, shall we say, disappointment that, you know, there weren't some stronger commitments made. But I think there's also a recognition that there is, you know, a clear direction of travel now towards greater commitments. And I think, you know, the fact that there'll be another meeting in 12 months' time where, you know, there is now pressure to increase commitments to environmental emissions reduction is the clear direction of travel. So in terms of what we do, you know, we are wanting to be ahead of the curve. We're wanting to, as I say, make sure that our particular investments are future-proof from that perspective. But it's always been, as I say, a natural motivation because it's the better thing for the tenant anyway.
Sure, thank you. I think time for maybe one more question. What are you most concerned about going into 2022? And I want to add to that as well. What are you most excited about?
Okay, what am I most concerned about? I think obviously the pandemic and the impact that that's had on society is still playing out in so many different ways, both in individual lives and in kind of more macro societal ways. So I think, you know, that is still a massive concern. We've seen the ability of impact investing to respond to some of those challenges, which has been fantastic. Even some of our property funds that have been able to respond, for example, in homelessness, to the initiative to get people off the streets in the pandemic, but which then led to a knock-on problem of people being housed in hotels and where next. And so it's been great to see the impact investment approach respond even to this kind of short-term emergency change in the world. But I do think, you know, we clearly have some massive problems building up in areas of society as a result of the pandemic that we need to be very vigilant for. And those will affect the issues that we invest into. They will affect homelessness, they will affect domestic abuse. And to some extent, they've affected learning disability as well, because people have found it harder to move, you know, with a learning disability during a pandemic when they were more exposed. So that's my concern side. I think my optimism and my looking at the opportunities for next year, I do think there's a huge amount that can be done, particularly on the homelessness side, to scale up what is happening here. And I think I mentioned at the beginning of the presentation, you know, the recent involvement of the local government pension schemes in this area is a very interesting move by the institutional investor market to put serious amounts of capital behind these problems, whilst absolutely remaining within their fiduciary duties. And I think that could lead to a broader move of institutional investment into not just environmental, but also social impact.
Brilliant. Thank you very much. And thank you for your time today. It's been a really interesting presentation and look forward to seeing more.
Thank you.
And thank you as well to all of our viewers today. Tomorrow will be our final day of the ESG conference.